Welcome to Breaking News to Trading Moves. We're jumping right in today because there's a major short seller announcement moving the market. A partnership led by Gotham City Research and General Industrial Partners has just revealed a short position in the data center REIT, Iron Mountain. That's ticker IRM.
And the reaction was immediate.
Yeah, Iron Mountain shares dropped about 5% right out of the gate. So today, our job is to examine the implications of this. We want to follow the capital and identify where the market pressure is, the groups we call the losers, and then, where that capital might rotate to, the winners.
Okay, so the core thesis against Iron Mountain, it really centers on their data center business.
They're spending, right?
Exactly. It's not just how much they're spending, but the short sellers are arguing that this spending is so heavily leveraged that it's just not sustainable. Not with the company's long-term funding capacity.
And I saw they mentioned aggressive accounting adjustments. What does that mean in this context?
That's the real sting in the tail. For a REIT like Iron Mountain, that usually means the shorts are questioning how management is calculating key metrics.
Like FFO?
Exactly. Funds from operations and adjusted FFO. Are they being, let's say, too optimistic with their valuation models? Are they capitalizing certain expenses to make the cash flow look a little cleaner than it is? And whether the claims are true or not, it immediately puts Iron Mountain IRM on the defensive. We're already seeing law firms, announcing investigations into their disclosures, which really turns up the heat.
So you've got this focused attack on one company's capital structure and its accounting. That's got to make investors nervous about more than just one stock. Let's start with the groups feeling that pressure first. The losers.
Right.
So beyond Iron Mountain, we're probably seeing stress across other REITs with high yield and high leverage.
You are. When the complexity and the debt load of IRM gets questioned, the market, it starts looking at others with a similar profile through that same lens.
So who are we talking about here?
Think about companies like Medical Properties Trust, that's MPW, and Unity Group, UNIT.
Okay, but those aren't data center REITs.
No, they're not. But what they share is that characteristic of having, complex balance sheets. They depend on these highly leveraged structures. MPW, for instance, relies on hospital sale-leasebacks, often with just a single operator.
So there's tenant risk.
A lot of it.
Huh.
And UNIT, it relies on a master lease with one major tenant for a huge chunk of its revenue. These are just more complex, more debt-intensive business models than, say, your typical apartment REIT.
And when debt and complexity are suddenly seen as the problem, which is what the IRM report is really about, it forces investors to reprice that risk everywhere.
That's it. It's a classic guilt by association scenario.
Okay, so that scrutiny then probably broadens out, right?
It definitely does. A big report targeting one leveraged REIT creates headline risk for the entire real estate sector.
And I'm guessing that shows up first in the big ETFs?
Almost instantly. We see it in the broad real estate sector ETFs.
So the big passive ones.
That's right. The Real Estate Select Sector SPDR, which is XLRE, the Vanguard Real Estate ETF, VNQ, and the iShares U.S. Real Estate ETF, IYR. These funds hold huge amounts of REIT exposure.
So it's just the easiest way to reduce risk.
It's the fastest. If a big asset allocator decides to trim their exposure to, leveraged real estate plays, the simplest way is to sell a block of these super liquid ETFs. It's a risk management move.
That makes sense for the equity side. But you mentioned this could also spill over into the debt market. How does that work? Why would an equity short report on IRM worry a bondholder somewhere else?
It's a really crucial connection. If the equity market even suspects that Iron Mountain's leverage is higher than what's on paper, that feeling just flows directly to the debt side.
So bond investors get spooked.
Especially the ones holding high-yield debt. They start asking if the company's ability to actually service that debt is as secure as they thought. And when that perception of credit risk goes up, credit spreads widen.
Which is the extra yield investors demand for taking on more risk.
Yep. And if spreads widen, it implies a higher default risk. That raises the cost of borrowing for all similar companies in the future. You see that pressure show up in the big high-yield bond ETFs, like the iShares, iBox, high-yield corporate bond ETF, that's HYG, and the SPDR, Bloomberg high-yield bond ETF, JNK.
So even if Iron Mountain isn't a huge holding in those funds, the general fear about leverage just pushes them lower.
Exactly. It's a generalized fear about credit risk.
Okay, so that's a lot of pressure.
Yeah.
It's hitting single stocks, it's hitting sector ETFs, and even high-yield bonds. If that much capital is heading for the exits, it has to go somewhere.
So let's flip this around and talk about the winners. Where's the money flowing to?
Well, the most direct winners, of course, are the traders who are bearish.
The ones who follow the report.
Right. This report is a catalyst for downside trades on Iron Mountain on IRM, either through shorting the stock or buying put options.
But it doesn't just stop with IRM. No. This intense focus on capital structures, it can trigger what we call sympathetic selling in other data center companies. Even the big ones, like Digital Realty Trust, ticker DLR, and Equinix, EQIX.
Hold on. DLR and EQIX are industry giants. They're usually seen as the quality names in the space. Is this just a knee-jerk thing, or is there a real connection to the IRM thesis?
It's not the same issue as IRM, but there is a connection. DLR and EQIX are growing incredibly fast.
Because of AI and cloud demand.
Right, but they're still REITs. They have to fund that immense growth by constantly issuing new equity or, more often, new debt.
And with rates where they are, that debt becomes a headwind.
A major headwind. The IRM report forces investors to look at the capex plans for DLR and EQIX and ask, okay, how much debt are they adding? How easily can they raise capital right now? It just creates a temporary pressure point for some bearish trades on them too.
Got it. That helps clarify the downside plays. But what about the true rotation? Where is the market actually moving money for safety?
Well, when complexity is penalized, capital often rotates towards perceived quality and, simplicity.
So defensive, lower leverage REITs.
That's exactly where it goes. If investors are moving away from these complex, high-yield structures, they start looking for simpler business models with just rock-solid balance sheets.
And who fixed that bill?
We see rotation into names like the logistics-focused Prologis, ticker PLD.
The warehouse giant.
Right, and the storage giant, Public Storage, PSA. And then the net lease name, Realty Income, which is ticker O.
So what makes those three safer in this environment? I mean, they're all still REITs.
It all comes down to transparency and lease structure.
Uh.
Prologis, PLD, their leases are long-term, often indexed to inflation, and their balance sheet is just very strong.
Okay.
Public Storage, PSA, is in self-storage. That's historically been very resilient in downturns, and it's a simple, low capex business. And Realty Income, they call themselves the monthly dividend company for a reason.
Their net lease structure.
Exactly. The tenants handle most of the operating expenses, which leads to very predictable cash flow. And that's what investors want when the market gets choppy. They give you that real estate exposure without the leverage or the accounting questions that the IRM report brought up.
So it's the classic playbook. When things get complicated, buy the names you can easily understand, the ones with less debt.
Pretty much.
But I think there's one last rotation point here, and might be the most important one for people who still want that tech exposure, the data center and AI theme, but they want to do it without touching REIT leverage at all.
They're moving into the mega cap cloud providers,
Right.
The hyperscalers.
Right.
Absolutely. Traders who want to play that long-term data center build-out are looking at Amazon, ticker AMZN, Microsoft, MSFT, and Alphabet, GOOGL.
And these companies are building more data center capacity than the entire REIT sector combined.
They are.
But they're also spending hundreds of billions. How do they avoid the same leverage problem that Iron Mountain is facing?
It's a totally different financial structure.
Absolutely.
Well, REITs are legally required to distribute most of their income. So to grow, they have to constantly go out and tap the equity or debt markets. Their whole model depends on access to cheap capital.
Whereas the hyperscalers.
The hyperscalers, Amazon, MSFT, GGL, they fund these massive build-outs from their own enormous cash flows. They have so much retained earnings, they can basically self-fund their own growth. Their balance sheets are clean, and for them, data centers are a feature of their core business, not the entire capital structure.
So it's a safer way to get exposure to the exact same growth trend.
It's a much safer way from a balance sheet perspective.
So the takeaway seems to be that a critique targeting one company's capital structure can make investors reevaluate their tolerance for leverage across a whole sector.
It does, and that leads to a measurable movement of capital favoring both defensive real estate and these adjacent tech plays that just have a superior funding model.
That really puts the spotlight on risk and transparency for any company with a lot of leverage. So here's a final thought for you to consider. Regardless of what happens with Iron Mountain in the end, how might these law firm investigations affect disclosure requirements for all highly leveraged companies? Could this force broader changes in how they report their numbers going forward?
And just before we finish, please remember that this is not financial advice or buy or sell recommendations. This is purely the opinion of the author.